Bad news for bonds is good news for stocks, says my next guest, Margie Patel from Wells Fargo. She's here to talk about it. Welcome.
Thanks to be here.
All right, so whenever the Fed talks about tightening or tapering, stocks generally sell off. So why is the reverse true in your opinion?
Well, because the Fed isn't really going to be tightening, they're just going to be buying fewer securities. And also, what I think is key is they still are anchoring short rates, the Fed funds rate, very near zero. So that means that there's still lots of liquidity out there for the rest of the economy, especially stocks.
So you don't think that the Fed's going to be doing any tightening in the near future? We saw Walmart come out with sales guidance that was less than stellar. So you don't think they're going anywhere?
No, and I think that's a great example that yes, the consumers have money, it's growing a little bit, but things are still pretty tight, and Walmart is a good reflection of that.
Does the Larry Summers, Janet Yellen debate matter to you? Should it matter to anybody?
It's hard to see if either of those will do something materially different from Bernanke, and I don't think so. So I think it probably doesn't matter from a point of view of Fed policy.
All right, so which stocks, in your opinion, will do the best if bonds do the worst?
Well, I think some sectors will do well almost regardless if the economy grows. I think some things, say in the basic industry side, Lyondell Chemicals, because they'll benefit from increased production and output, and also shale gas, which is making the U.S. chemical producer world cost low producers. And I think anyone related to the boom in auto sales and capital expenditures, I think Johnson Controls will be on a long-term upcycle, and even the European sales from that company I think will start to do a little better. That'll be a surprise.
So if we're worried about Walmart and the consumer's ability to buy small things, cheap things, what makes you think that they're going to be able to purchase big things like cars?
Because I think consumers have made a decision of how they want to spend their money. So money's a little tight. The things that they want to buy are autos. Fleet average age is over 11 years, so people are ready to buy cars. And also housing. We have a big buildup in pent-up demand for housing. With prices doing better, lots of people want to buy houses. And so those two sectors will be in a long term. And maybe at the margin, they won't have so much money to spend at the retail store like a Walmart.
And then finally, we saw the 10-year tick up from 1.8%. It's now yielding around 2.8%. It's moved fairly quickly. I know that bad news for bonds is good news for stocks. However, at what point does a move up in the 10-year, just to use an example, where does it become bad news for both?
I think that we'd have to have a material increase in the 10-year rate. Maybe if we're at 2.8 right now, maybe to 4%, 5%, because that would show the Fed was really tightening, but we're nowhere near that. And I think actually this move that we've had is really premature. Maybe short-term traders anticipating rates going high, way above I think what's going to happen. Low inflation, I wouldn't be surprised to see 10-year rates go down over the next few months.
Thanks a lot, Margie.
Thank you.
Thank you for watching The Street. What did you say? Did you say something, Jeremy? Oh, sorry about that. Hang out there. Thanks a lot, Margie.
Thank you.
And thank you for watching The Street.